Let's get right to it. July could define your portfolio for the rest of the year. The market's on edge. The Fed, big tech earnings, and global tensions are all converging. I've cut through the noise to bring you the 3 signals that matter most for your money. Ignore these at your own risk. This is about being prepared, not scared. We'll break down what's happening, why it matters, and what you should do next. Let's dive into the 3 critical market signals for July 2025. First up, all eyes are on the Federal Reserve and their next anticipated move. The financial world is holding its breath, waiting to see what Chairman Powell and the board decide. The FOMC meeting this month, specifically July 30th and 31st, is everything. The decisions made behind those closed doors will ripple through every sector of the economy. Will they continue their aggressive stance and hike rates again, pushing borrowing costs even higher? Or will they finally signal a pause, giving the economy a chance to catch its breath after a year of relentless tightening? If inflation runs hot, stubbornly refusing to fall back to the Fed's target, expect another hike, potentially a quarter-point increase, maybe even more if the data is alarming. That would be bad news for tech stocks, which are particularly sensitive to interest rate changes, and growth names in general, as higher rates make future earnings less attractive. If inflation cools, showing signs that the Fed's policies are working, a pause could ignite a rally, sending stocks soaring as investors breathe a sigh of relief. The yield curve remains inverted, a classic recession indicator, flashing recession warnings, reminding us that economic uncertainty is still very much present. The Fed's decision will ultimately shape the entire market's direction, dictating whether we see continued volatility or a path towards more stable growth. Now's the time to manage risk. Prudent investors are preparing for all possibilities. Consider trimming speculative tech positions, especially those that have already seen significant gains, and rotate into defensive sectors, which tend to hold up better during economic downturns. Sectors like consumer staples, companies that provide essential goods and services, or healthcare, which is always in demand regardless of the economic climate. Don't get caught off guard. The market can react swiftly and unexpectedly. Volatility will spike, almost certainly, if the Fed surprises the market with an unexpected decision. Watch the bond market closely for clues on big money's next move. Institutional investors often signal their intentions through bond trading activity. The Fed's call will set the tone for borrowing costs, corporate earnings expectations, and overall market sentiment for months to come. Mark your calendar for the FOMC announcement and be prepared for potential market swings, and pay close attention to the upcoming inflation report. Dig into the details, analyze the underlying trends, not just the headlines. Understand the nuances of the data. This is your top priority as an investor right now. Stay informed, stay vigilant, and stay prepared. Be ready for either outcome and position your portfolio accordingly. Next, all eyes are on big tech earnings. Apple, the tech behemoth, Microsoft, a leader in cloud computing, and Google, the king of search and advertising. These giants have been the primary engine that has driven the S&P 500's impressive rally this year. Their performance has been pivotal. Now, with earnings season upon us, they must deliver real, tangible results that justify their valuations, not just promises and AI hype. The market demands substance. Weak iPhone sales figures, slowing Azure cloud growth, a key growth driver, or a Google ad revenue miss falling short of expectations could quickly trigger a significant tech sell-off, reversing recent gains. Strong numbers, though, exceeding expectations, could fuel a new, even more powerful bull run, pushing markets higher. Closely watch Apple's iPhone sales performance and their forward-looking guidance for the next quarter, Microsoft's Azure cloud computing growth trajectory, and Google's all-important ad revenue streams. The market's already priced in a significant amount of optimism and positive sentiment, so even good news, in line with expectations, might simply not be enough to sustain current valuations. If you're heavily exposed to these tech stocks, consider hedging your positions or trimming your holdings before the earnings announcements. Ultimately, the market's immediate reaction matters far more than the raw numbers themselves. Carefully watch how these key stocks trade in the hours and days after the reports are released. This upcoming earnings season will either validate the current market rally and confirm the bull market's strength, or it could be the catalyst that finally pops the bubble. Therefore, stay alert, informed, and prepared for anything. Third signal. A subtle yet powerful force that can reshape investment landscapes. It's the undercurrent of geopolitical shockwaves, events rippling across nations and economies. These events, often unforeseen, can trigger significant market reactions. Consider Middle East tensions, a persistent source of instability, and the ever-present specter of China trade disputes, a tug-of-war with global implications. These factors could conspire to spike oil prices dramatically, sending shockwaves through various sectors. This, in turn, could disrupt supply chains, creating bottlenecks and impacting businesses worldwide. Rising oil acts like a tax, an unavoidable expense that eats into consumer spending and business profits. This has a cascading effect on the global economy, slowing growth and creating uncertainty. It could reignite inflation, a persistent threat that central banks are constantly battling. This inflationary pressure could force the Fed's hand, compelling them to take action. A sudden oil spike, fueled by geopolitical turmoil, is a black swan risk, an unpredictable event with severe consequences. Therefore, watch crude prices closely as they serve as a barometer for global risk. Trade tensions with China, a persistent source of friction, threaten companies like Apple, whose supply chains and markets are deeply intertwined with China. These tensions add uncertainty, creating a climate of fear and hesitation among investors. And uncertainty is what the market hates, leading to sell-offs and bearish sentiment. Protect yourself. Take proactive steps to safeguard your investments. Consider energy sector exposure, as energy companies often benefit from rising oil prices. Use it as a hedge, a way to offset potential losses in other parts of your portfolio, and hold extra cash, providing you with flexibility and options. This cash position offers financial flexibility, allowing you to capitalize on opportunities. 10 to 20% cash, a healthy allocation, can help you weather volatility, providing a buffer against market downturns. It also allows you to seize opportunities, buying undervalued assets when others are selling. Focus on high-quality, resilient companies, US-based companies, which may be less exposed to international risks. Prioritize domestic companies with limited international risk, offering a degree of insulation. Think proactively, anticipate potential risks and opportunities. Don't wait for headlines to react, be ahead of the curve. Geopolitical risks, though often unpredictable, can move markets fast, creating both dangers and possibilities. Position yourself defensively, protecting your capital while remaining open to opportunities. Be prepared, not surprised. A well-thought-out strategy is your best defense. July is a make-or-break month. The Fed's decision, big tech earnings, and global tensions all collide. Volatility is almost guaranteed, so have a plan. Manage risk, trim high-flying tech, add defensive hedges, and raise some cash. Stay informed and act, don't just react. The prepared investor will find opportunity in the chaos. Subscribe for updates as we track these events. Thanks for watching. See you next time.